The barter method represents one of the first stages of the monetary system in human history. This system is an economic model where goods and services are directly exchanged in a trade. People engage in trade by exchanging the things they need with the things other people need. The barter method is essentially a system of mutual agreement. For example, a farmer can make a deal with a tailor who wants to obtain a portion of the farmer's produce. The farmer will receive some clothes that the tailor needs and, in return, give a portion of the products they have produced to the tailor. This way, both parties fulfill their needs and engage in a trade of goods. However, the barter method can encounter certain challenges and limitations. Firstly, barter transactions need to mutually fulfill the exact needs of both parties. For instance, if a farmer wants to barter their products with another farmer, the other farmer needs to have the specific goods the first farmer requires. This can make barter transactions complex and time-consuming. The barter method can also face issues with portability and divisibility. For example, if a farmer wants to barter their cows for wheat, determining the value of the wheat accurately can be difficult. Additionally, physical challenges such as transportation and storage can arise in large-scale barter transactions. What do you think about the future of cryptocurrencies? Will they be in competition with traditional currencies or complementary to them? How can decentralized finance, DeFi, change the financial system? What advantages and challenges may arise? With the acceptance of digital assets, cryptocurrencies, CBDCs, how do you predict the transformation of currencies and financial systems? For all this and more, before starting the video, if you're interested in universal economic history, you can subscribe to my channel and turn on notifications to be informed about new videos I upload every day. Enjoy the watch.
Universal economic history.
The agricultural revolution is considered a significant turning point in human history. This period marked the transition from hunter-gatherer societies to settled agricultural societies with increased agricultural production. With the discovery of agriculture and the development of agricultural techniques, people became capable of producing more food, leading to population growth and the complexity of societies. With the emergence of the agricultural revolution, the exchange of goods and services became more complex. People started engaging in trade not only based on natural resources but also on the products they obtained through agriculture. However, this brought about challenges such as the transportation and storage of agricultural products. Gradually, the concept of money began to emerge after the agricultural revolution. Several factors influenced the emergence of money. Firstly, the increasing complexity of trade and the diversity of goods and services made barter transactions more difficult and inefficient. People felt the need for a universal medium of exchange rather than direct bartering. Metallic money is considered a significant milestone in human history. Metallic money refers to a monetary system where valuable metals, typically gold and silver, are used as a standard medium of exchange. Metallic coins gain value based on the amount of valuable metal they contain and serve as widely accepted trade instruments. Metallic money primarily emerged during ancient times. People preferred valuable metals as trade instruments due to their scarcity and durability. Over time, gold and silver were adopted as universally recognized units of value. This made trade easier and more reliable. The rise of metallic money is closely related to the expansion of trade and increased economic interaction. The use of valuable metals facilitated the exchange of goods and services and increased the volume of trade. By bartering their goods and services for metallic coins, people were able to engage in trade more efficiently and quickly compared to previous barter systems. Paper money represents a significant milestone in human history as a form of currency. The discovery and development of paper money facilitated trade, increased the portability of currencies, and stimulated economic growth. The origins of paper money can be traced back to 7th century China. During the Tang dynasty, the increase in trade and challenges associated with the transportation of valuable metals led to the need for paper money. Initially, Papers used as documents for storing valuable metals gradually started to serve as a medium of exchange due to their increasing acceptance and convenience in trade. The development of paper money gained momentum during the Song dynasty. The Song dynasty started to widely use paper money and established the issuance of paper money under the control of the central government. This formalized paper money as an official currency and supported the growth of trade. The functions and reasons for money. Money is a fundamental element of an economic system and serves various functions. Below are some important points explaining the functions and reasons for money. Medium of exchange. Money is a universal medium of exchange used in the trade of goods and services. People can easily exchange their goods and services for money and then use that money to obtain other goods or services. Money facilitates trade transactions and enhances efficiency. Unit of value. Money serves as a unit for measuring the value of goods and services. The monetary value of a good or service is determined by the currency unit. Money provides a standard for measuring and comparing economic value. Store of value. Money serves as an asset that can retain its value. People can save money for future needs and engage in savings. Money is more liquid and accessible compared to other types of assets, making it preferred for accumulation and savings purposes. Throughout the history of the monetary system, several significant milestones have been reached. Here are some historical milestones such as the gold standard, the Bretton Woods Agreement, and digital currencies. Gold standard. The gold standard refers to a monetary system where currencies are fixed to a specific amount of gold. It was widely used during the 19th and early 20th centuries. Under the gold standard, each currency had a specific value equivalent to a certain amount of gold, and the value of currencies was determined by gold. The gold standard aimed to stabilize currencies and facilitate international trade. However, it was abandoned due to economic fluctuations and wars. Bretton Woods Agreement. The Bretton Woods Agreement was signed in 1944 after World War II. The agreement aimed to establish an international monetary system. Under the agreement, the US dollar was fixed to gold, and other currencies were pegged to the dollar. This system was created to facilitate international trade, maintain stable exchange rates, and encourage economic cooperation. However, the Bretton Woods system ended in 1971 when the US halted the conversion of dollars into gold. Money plays an important role in the context of globalization and international trade. Here are some key points about the strengthened role of currency in globalization and trade. Facilitation of international trade. Currency serves as the foundation of international trade. The exchange of goods and services between different countries typically occurs through the use of currencies. Exporters set their prices in their own currencies, and importers make payments using those currencies. The widespread acceptance of currencies facilitates international trade and its growth. Currency valuation and competition. Currencies are used to create competition and provide trade advantages between countries. The value of a country's currency can fluctuate in international markets. These fluctuations can affect the competitiveness of exporters. For example, if a country's currency depreciates, exports may increase as exporters become more competitive. The future of money is undergoing significant changes with the emergence of technologies such as cryptocurrencies and decentralized finance, DeFi. Here are some key points regarding the potential impacts of cryptocurrencies and DeFi on the monetary system. Cryptocurrencies. Cryptocurrencies are digital assets that have emerged as alternatives to traditional currencies. Operating on blockchain technology, cryptocurrencies offer secure and fast transactions without the need for central authorities. Cryptocurrencies can enhance transparency in financial transactions and facilitate cross-border payments. Decentralized finance, DeFi. DeFi aims to change the financial system by eliminating traditional intermediaries through the use of blockchain and smart contracts. DeFi protocols offer various financial services such as lending, trading, insurance, and investment. DeFi seeks to provide more transparency, accessibility, and democratization in the financial system. The future of money will likely be influenced by the adoption and integration of digital assets, advancements in financial technologies, and evolving global economic dynamics. Thank you for watching my video. If you liked it, please hit the like button. If there's a specific video you'd like me to make on economic history, don't forget to mention it in the comments section. I wish everyone a pleasant day.
Universal economic history.